So I think the market's discounted this already mainly, and that the low potentially is in, because what will be happening in 12 months' time? In 12 months' time, we will have seen a recession and we will likely be coming out of it. Whether we're fully out of it or not, doesn't matter. A recession at some point in the future means that the Federal Reserve will stop hiking and will stop shrinking the balance sheet. And they will probably go towards cutting. In the future, in 12 months' time, the probability of inflation being, at 8% is extremely low because of the year-on-year computational differences and the fact that oil, copper, freight rates, everything has come down massively. So I'm thinking that there is a probability that inflation goes negative within 18 months. So if we look out 12 months, the recession is behind us, rates are lower, and inflation is low. Okay, so that is a very good outcome for risk assets and crypto. Crypto bottomed in June. We had the retest. Bitcoin had a retest only 2 days ago, and I think it was the retest. So my DMARC indicators, which I use mainly for my technical analysis, gave me that signal. ETH had a much stronger signal in June, and I started finding as much money as I could under the sofa anywhere to start investing, adding to my positions. I never sold anything. So I'm thinking the markets are forward looking. I think the sentiment is extremely bearish, and we're going into a potential change in the macro. Does it happen this month, next month? Don't really care. Then we've got the ETH merge, which we all know about. I don't think it brings fireworks. Maybe it does. Maybe there's a big sell-off after it, big sell-off beforehand. I don't really know. And again, I don't really care. What I do know is that post-merge, a few things happen. There are no miners to sell every day. That's about 6 billion that disappears from selling each month. Okay, so that's a difference. Then we've got the reduction in supply, but that's really driven by the increase in network activity. So we need to kind of see the network go up a lot for that to really kick in. It become deflationary, but it's less inflationary. So there's less ETH around, but then we've got this magic. The magic is you've just introduced yield into the ETH ecosystem in a secure way. So therefore, because it's at protocol level. So therefore, this is going to attract new people into the ecosystem who want to get ETH for yield. So you've got a demand shock. Also, the lack of the ESG restrictions that people have with Bitcoin, falsely so, but I understand that that's the mandate people have got. So you've got people who are frustrated who wanted to invest but couldn't because of ESG and Bitcoin. The ETH merge, they're waiting for it to happen. ETH now has a yield. A lot of institutions don't own gold because it doesn't have a yield. So you've got this technology asset that represents a big, exciting future with a yield, with a limited supply. So that has and a macro that's changing. That to me suggests the next 12 months probably very, very good for digital assets. So that's at the basic level. And then I'm trying to think through, okay, in a new world where ETH is this very important asset, it's still going to have problems. It's still going to be expensive and it's still going to be slow. So as adoption keeps building, a lot of adoption spills outside of the ETH into the Solana, Avalanche, and a bunch of other protocols as well. So I think we're going to see ETH lead the charge, and then we'll see this tail of stuff starting to come as we start a new bull market. And generally things work that way. So I think a lot of these layer ones this time around will be like ETH in the last cycle. They'll end up becoming very large dominant change. Which ones? Yeah. Don't really know. My bet's really on Solana, but it could be any of these, and I'm kind of indifferent right now. Solana's, as I said, I got more allocated towards that than I have to some of the others, but I'm watching them and waiting to see. I've had also technically a perfect monthly, daily, weekly DMARC setup in the Solana ETH cross. Now, I'm not yet ready to make the bet that I would switch my ETH into Solana, but I have some. But I'm observing that to say, let's see if that plays out, because that will be a narrative that people don't really expect. And I'm not saying that Solana becomes bigger than ETH or anything of that sort. I'm just saying, could it outperform in this cycle? So I think we're at the new cycle point. the logarithmic chart, we got to the 2 standard deviations oversold, everybody knows the on-chain metrics. We've got the perfect setup. Is it today? Is the low in? I would give it an 80% probability, but there's a 20% chance it's not. So I'm very focused right now on watching the price structure. And the final thing to give you is the big one for me is ETH breaking about the 2000 level. That would give us an inverted head and shoulders low. And also there's a downtrend from the high, and it would have then broken a wedge pattern to the upside. And that would be the start of the run to new highs whenever that occurs. The thing that drives crypto that everybody has now learnt is the adoption cycle. So how many people are adopting? And we're seeing, for example, the number of wallets in Ethereum and stuff go up, but the overall activity of these networks are pretty stable. They came down from peak, they've remained stable, and that's why the price action's been sideways, trended lower in the summer as we had all of the CeFi shocks. But the main driver of all of this is liquidity. Liquidity drives all financial markets. Liquidity, for the definition here, would be the kind of ease of which money flows around the system. And I can use money supply growth, M2 growth globally. And obviously with the central banks all jacking up rates and shrinking their balance sheets, what they're actually saying to you is we want to take liquidity out so you guys can't do as much speculation. Now, what that means is things like your credit card rate goes up, your mortgage rate goes up, you've got less money to spend on stuff. So liquidity, your liquidity has been taken out of your pocket. And it's the same for everybody, particularly because there's so much debt in the system. However, our job is not to live in the present. Our job is to live in the future. And we need to understand where the future lies. So Stan Druckenmiller importantly said that the job in macro is to see 12 to 18 months out, because the asset markets tend to price the future. So right now we can hear people all on Twitter saying, we're going into a recession. It's clear there's going to be another leg down in equities because they need to price in the recession. That's assuming that everything operates in real time, but it doesn't. So when I look at the year-on-year rate of change of, let's say, the NASDAQ, and compare it to the ISM index, which is my guide to the business cycle, the Institute of Supply Managers survey, it suggests that the ISM survey, the NASDAQ is pricing in ISM at around 40. ISM at 40 is relatively deep recession. ISM at 47 is usually a recession level, and 40 is something, to the order of magnitude of kind of negative 2% GDP growth. So it's already priced in. The S&P is similar. Things like copper are close, oil less so, but coming down over time in line with the business cycle. The exponential age stock, so the long end of technology, the ARK style investments, they priced an even deeper recession. So they got down to about 35 in the ISM, which was very, very low. Since I first discovered Bitcoin in 2013, been of the opinion that this was a parallel financial system that's being built. In the last 18 months, I've realized that it's bigger than just a financial system. It's in fact the entire system of value, transfer, storage, and ownership in the new digital world. It is probably one of the biggest things I've ever heard of or seen, and it is an incredibly exciting moment in time to be part of it. And it's like learning about the discovery of oil when the Rockefellers and all of these guys started figuring out that the oil was going to make the world go round. Had you been an investor and a participant and understood what it could do and what businesses you could build across the network of oil or the mobile phone or the internet, the fortunes that were made, the changes that happened were so staggering, and this is happening faster. And at the very center of it is a system of money and value, which means that in itself, it is going to accrue value faster than anything else, because that's what it's actually doing, is taking value from old places and putting it into a new place. So the opportunity set is so big, and it is that perfect nexus of macro and crypto, because the macro is so fucked, which we've known for so long, the massive debt, the bad demographics, the polarization of the world again, the deglobalization, the globalization, all the mess that caused. All of that is going on in macro land, which is pretty miserable. And here's the solution in front of our eyes. I mean, what a time to be alive. And that's why it's so important. Everybody needs to understand this stuff, whether you're trading this stuff, building businesses, or you're just observing it, it is incredibly, incredibly important. So ISM going down, what does that say? It says that the probability of stimulus in the future is going up because the economy is slowing down. So basically about 9 months ago, ISM peaks and starts going down. So that tells you that in 9 months' time, i.e. about now, we should start to see a turn of stimulus. Do we see any evidence of that? Well, in Europe, they're starting to do stimulus, but it's in this direct handout stimulus pattern that I've talked about in the past, which is, hey, listen, you guys are getting killed on your electricity bills. Let us help you. It's still stimulus. It's not central bank printing yet, but the stimulus coming into the system, and it's happening in China. It's happening in Europe. The Japanese are doing something different. They are expanding the balance sheet by buying JGBs and devaluing their currency. It's called yield curve control. The US, many states have given out handouts to pay for electricity bills. So at the margin, things are changing. The bond market's still thrashing around trying to figure this out because the quantitative tightening is confusing the picture for bonds because bond liquidity is ultra low, as bad as it was. Well, not yet as bad, but it's the second worst it's been since the global financial crisis. So there's an issue going on there. But generally speaking, if I look at things like forward break-even rates, they're telling us inflation is kind of in free fall right now. So those are all of the things that will tell us this. But ISM 9 months forwards, so as long as ISM is falling fast, the probability goes up. I looked back and found that every single time the ISM crossed 50 to the downside, the Fed stopped or cut, stopped hiking or cut. They only stopped hiking once, which was 2016. Every single other time they cut soon after. Now, because of this inflation narrative that's left, I don't think they cut immediately, but I think they stop pretty fast. As soon as they see the economy imploding, unemployment ticks up. So they're all the same kind of indicators. M2 is just another way of expressing it, which is economic growth bad, needs to get stimulated. You can't let anything go wrong. So need to bring down inflation expectations, need to raise rates. Holy shit, the Italians can't pay their bond coupons. Okay, we won't allow those spreads to widen. Okay, that means our currency is probably going to go down. Okay, we can deal with that, that's fine. But oh my God, we can't let households suffer the pain here, so we need to give them money. But that's stimulative, so we need to be careful not to bring inflation back, so we're going to raise rates, right? It's this excessive control over the economy, almost like a command economy like China. And the reason being is there's too much debt. And so you can't let the whole thing blow up.
Right.
It's the fear of the big blow up. Now, I think the ECB knows how to stop the big blow up, which is debase your currency. That's the way, the central bank balance sheet. But they don't want to go there yet because they can't. So you have to play this game. But basically, it's this desperate game to keep all the balls in the air and not let them all fall to the floor. If you were given the job, if you were Christine Lagarde, what are you going to do? Let it all burn? No. So you kind of don't get the choice. You're stuck. You're stuck trying to plug the leaky boat with your fingers. So you've got your toe there, your finger there, but there's another leak. I say, oh shit, I'll do that, and I'll go back. That's the game they're all playing. All of them, the Fed, the ECB, the Bank of Japan, the PBOC, the whole damn lot. It's not the end of the world. Europeans can export more. Maybe it makes the Italians and the Spanish more competitive on a global landscape. Who knows? It doesn't have to be apocalyptical. And if you can do it in a slow enough way, the yen was 48% in a year and a half, which is pretty staggering for the third largest currency traded pair on earth to have moved that fast. And nothing really broke. So look, it's okay. It doesn't mean the end of the world. I've never seen Twitter so apocalyptical about everything. It's like Europe's going into the Stone Age this winter. There's going to be bodies in the streets. Everyone's going to be rioting. There's a nuclear war going to go on. Everybody calm down. Those outcomes, there is a probability, but it's not the highest probability. Europe, there's a lot of smart enough people. They might have made some policy mistakes, but they'll figure it out. Andreas Steno Larsen talks about this a lot, is people, particularly on the US side of the pond, looking at the European side of the pond, are much more apocalyptical.